Welcome to Broker Compensation Training with UWM. In 2013, the CFPB issued regulations to implement the Dodd-Frank Act, which modified LO comp requirements originally made effective by the Federal Reserve in 2011. These rules were put into place to restrict brokers and loan originators from being paid on the terms of loans they originate or a proxy for a term of a transaction. LO comp restrictions affect how brokers are able to adjust their compensation. Specifically, compensation may not be reduced for competition or to pass high-cost tests. This is because there is a concern that compensation may be set artificially high and only selectively lowered. Selective reductions on compensation both runs afoul of the compensation rule, but can also open loan officers and brokers up to a potential increased risk in fair lending disparities. So it's very important that brokers continue to monitor fair lending closely. A term of a transaction is any right or obligation of the parties to a credit transaction. That means a term can be the transaction's interest rate, annual percentage rate, type of collateral being purchased or sold, or even a prepayment penalty, among others. Importantly, the amount of credit extended is not a term of the transaction or a proxy for a term of a transaction, provided that the compensation is based on a fixed percentage of the amount of credit extended. So what is a proxy? A proxy is defined as something that both consistently varies with the term of the transaction over a significant number of transactions, and the loan originator has the ability to control or influence the factor during the origination of the transaction. When signing up with a lender, each broker is required to define a compensation plan. The compensation plan is the amount of compensation they are paid on each lender-paid transaction. These plans are generally based on the percentage of the loan amount and may also include a flat fee. These plans may be set based on each state that the broker is licensed to operate in. So what are the rules for lender-paid compensation plans? The law allows that they can have a minimum and a maximum to ensure they properly account for fixed costs on lower loan amounts as well as remain competitive on larger loan amounts. UWM allows a plan maximum which cannot exceed $40,000. UWM does not have a plan minimum. Brokers can choose whatever amount works best for their business model. UWM does not allow compensation plan percentages that exceed 2.75%. UWM has a 90-day waiting period from when the last compensation plan change occurred before another change can be requested. The good news is, EASE is built to ensure that the compensation plan factors are followed for each lender-paid transaction. Now let's talk about borrower-paid compensation. Although brokers and loan originators are able to negotiate compensation directly with the borrower, there are limited instances where the borrower-paid compensation is able to differ from the broker's compensation plan. A loan originator may not reduce its compensation to match a competitor or agree to pay a portion of the consumer's closing costs by reducing compensation to avoid triggering high-cost mortgage provisions to include QM. It is important to note that switching from lender-paid compensation to borrower-paid compensation in order to pass QM is permissible as long as compensation is not reduced. Borrower-paid compensation plans are only able to vary from the lender-paid plan where the variance is associated to something that is not term-related. Here are examples of such situations. The consumer acquisition cost. Providing reduced compensation based on the acquisition cost of securing the lead, including whether there was any such cost, such as a repeat client. Because the borrower is an existing client and as such, less work is required to originate the loan. For example, Jeff has been a client for years and has originated multiple loans with Joe, most recently a few months ago. Because Joe has all of Jeff's information already, it's easier for him to take the loan application and there are lower costs associated with soliciting the borrower. The borrower is a mortgage professional and is able to provide accurate and complete loan documentation, making the origination easier to process because the borrower was able to provide all the needed documentation without any instruction or follow-up. Or self, family, or friend loans. Providing reduced compensation to a loan broker who originates a loan for him or herself or for a family member or close friend. The borrower is a family member and the discount should be consistent for all friends and family members. In both of these situations, the LO would submit the loan with the reduced comp plan as this information is known prior to submitting the loan. Remember, a loan originator may not reduce its compensation to match a competitor or agree to pay a portion of the consumer's closing costs by reducing compensation so as to avoid triggering high-cost mortgage provisions, including QM. However, a loan originator may flip from lender-paid to borrower-paid in order to pass QM, as long as the compensation is not reduced. Flipping to borrower-paid can sometimes eliminate points, which, when not bona fide, can add expenses to QM points and fees. Borrower-paid compensation can be reduced to offset unforeseen settlement costs to the consumer, such as unforeseen increase in an actual settlement cost in comparison to an estimated settlement cost to the consumer. An unforeseen cost occurs that is not disclosed to the borrower but becomes required due to a change in the loan. For example, Sally locks her loan for a purchase, but an appraisal issue causes delays and the closing is delayed a week, therefore the lock expires. Sally still wants to proceed with the transaction, therefore she needs to relock the interest rate. Because the appraisal issue was unforeseen, the loan originator may decrease their compensation to cover the cost of the rate lock. When it comes to switching compensation from lender-paid to a lower borrower-paid amount, there are several other acceptable reasons. They are slightly more limited and include the following. There was an unforeseen increase to any fee disclosed on the loan estimate or required to be disclosed on the loan estimate. The borrower is short cash to close. There was an increase in the fees related to the payoff. There was an unforeseen circumstance which required debts to be paid off. Again, the good news is EASE is built to ensure that reductions in borrower-paid compensation are based on a permitted reason discussed in this training. UWM does not allow borrower-paid transactions to exceed the amount of the broker's lender-paid compensation plan that would otherwise apply. UWM monitors borrower-paid loans to ensure its brokers are maintaining compliance and not being paid based on the terms of the transaction or proxies thereof. This includes monitoring for situations where brokers are purposefully inaccurately disclosing fees so they can reduce their compensation by paying for the resulting restitution. With regards to how brokers should pay their loan officers, the same rules apply in that they cannot be paid based on terms of a transaction or practices thereof. Ultimately, the underlying concept with paying brokers and loan officers compensation is to avoid paying them based on factors that they can control. Please also remember that when varying loan officer pay, especially when reducing it, you still must comply with state and federal minimum wage and labor laws. Thank you for joining me today. And if you have any questions, please reach out to your UWM account executive.